Welcome. If you're age 73 or older, the tax forms that you received this year likely included a Form 5498. Form 5498 states your required minimum distribution. That's the amount of money that you must take from a qualified retirement plan this year. But what exactly is a required minimum distribution, and what are different ways to plan for it? Let's take a closer look. Now, an RMD, required minimum distribution, applies to all pre-tax retirement savings vehicle. This is a traditional 401k, traditional IRA, traditional 403b, a SEP IRA, a SAR-SEP, a simple. Any pre-tax retirement savings vehicle is subject to a required minimum distribution. The retirement vehicles that are not subject to an RMD are Roths, Roth IRA, Roth 401k. There is no RMD because the money that went into that plan is already after tax. And essentially the point of the RMD is to tax money that is yet to be taxed. So the way this works is if you were born before 1951, so 1950 or earlier, then you had an RMD beginning at age 70 and a half. If you were born between 1951 and 1959, your RMD begins at age 73. And if you were born 1960 or later, your RMD will begin at age 75. That's when you must start taking distributions from the account. Now, the amount that you have to take is based on a calculation. That's the table that we see in front of us now. And it starts at a smaller amount and then increases on a percent basis over time. So what we see on the left-hand side is the denominator in this equation. So the numerator is your account value on December 31st of the previous year end. So your required minimum distribution for 2026 is calculated by taking your account value at year end 25 and then dividing it by the number that corresponds with your age. And essentially what that works out to on a percent basis is that the first year of your required minimum distribution, you have to withdraw roughly 3.8%. So on $1 million, you have to withdraw $38,000. And then that increases over time to age 100, and you have to withdraw 15.6% of the value of your IRA. Now, importantly, the penalty for failure to take a required minimum distribution is very steep. It's a 25% penalty on top of the ordinary income tax that's applied. So it's very important to satisfy your required minimum distributions and avoid that additional 25% tax. Many people in retirement need to take distributions from their IRA to live, so the RMD really isn't that big of a factor. But what if you don't actually need the money? What are some options to consider? The first is a QCD, a Qualified Charitable Distribution. And for many people who are of RMD age, making charitable donations through their IRA via a QCD is the most tax-efficient way for them to give to charity and counts towards satisfying the required minimum distribution. For other folks, it's a partial Roth conversion. This is paying taxes to convert money from a traditional IRA to a Roth IRA, so it's no longer subject to required minimum distributions. And for other people, it's as simple as taking your required minimum distribution, withholding taxes on that, and sending the net amount to your taxable account, whether this is a trust, a joint account, an individual account. And then once it's in that account, then you can control when you take distributions from that after-tax account. RMD planning is part of a proper wealth management relationship, not to be viewed in isolation, but in coordination with your other financial assets and your goals. Thanks for watching. Enjoy today.